Hey, in this video, I want to go through the wealth hierarchy. Now, a lot of people think they have this figured out and they know what these should be. And as you see, I've got a somewhat of a food pyramid, but let's call it the wealth pyramid. Now, if you aren't aware of what's going on, this is kind of an interesting subject because the food pyramid that we always thought that we've always been taught to follow and that the FDA and all those people got behind and pushed, our government pushed, where you had 6 or 8 servings of bread at the bottom of your food pyramid, and then you built some carbs and protein, and at the very, very top, it was like fats, right? And now we're realizing, what are we realizing? I hope you've realized at this point, a large part of the population is realizing that the food pyramid was upside down. It's completely upside down. Fats are good. Our great grandparents lived off fats. They cooked in lard. We're starting to realize that the fats themselves aren't what cause heart disease, right? It was smoking, a lot of different things that cause that heart disease. Heck, we're even realizing that cholesterol may not be as bad as we thought. It's sugar and artificial sweeteners and all kinds of things that are the problem, right? So we know that the food pyramid is upside down. Do you think you can trust the government to tell you what this wealth hierarchy should look like? Right now, we think that stocks and bonds and Wall Street should be the base of this, and you'll see that. Most people will say a 60-40 split between stocks and bonds and mutual funds thrown in there in the stock portion. That is a healthy wealth hierarchy. To me, that's like somebody eating bread and sugar all the time. So I'm going to set something in front of you, and you've got to decide if it makes sense or not. If it doesn't, this video is not for you. Probably investing in alternatives is not for you. But I think you may have a misconception of what is safe, because when we look at this pyramid, as we go up, we're going to build a foundation which is a more safe foundation, and we're going to go all the way to the top, filling in this pyramid, okay? So I'm going to talk about some things you may not know much about, or you may have an absolute adverse reaction to, okay? And one of those is going to be at the bottom of this pyramid. So hear me out before you decide to turn this video off or go on to something else. Hear me out and why we're going to do this. But I think this will make sense to you that at the bottom of this pyramid, we need safety. So what is safety? For me, and for most people, it's cash. And for me, it's infinite banking. What in the world is that? If you don't know what infinite banking is, it's using specially designed, overfunded, high dividend, whole life policies as the basis of everything down here. Now, what should a foundation have? And that's the reason we're going to talk about this, because there are unique things that we need to get out of this base, okay? Obviously, we need to be down here. It's got to be the low risk. It's got to be the lowest risk, okay? Cash is the lowest risk. Sitting on cash in a safe or stuffed in a mattress is low risk. There are some problems there, but it's got to be low risk, okay? It's got to be liquid, because for it to be safe, it's got to be liquid. You got to be able to get to it in a fast time. It doesn't have to be instantaneous liquidity, but it has to be within a week or less, if not sooner. And for me, for something to be down here and be base, I want it to be super tax efficient. Okay? Those are the 3 things I need my base to be. That's what I choose to build on, because in my mind, in the mind of many wealthy people, this infinite banking is the absolute safest place to build a foundation upon, okay? Now, the cool thing is there are some things I do where I take money from the base and I go up here and venture a little bit into higher risk investments. That's perfectly fine. That's why I like infinite banking. Your base could be bonds, it could be treasuries, it could be other things. I tend to try to, since I think the government screwed up on the food pyramid, I've lost a little bit of trust in the government. So I don't necessarily throw all my money into government sponsored programs and IRAs and things like that, because I don't trust them. Why should I trust the government. You give me a good reason why I should. All right. As we go up the risk, there's a little bit more risk when we get into real estate and private equity. Now, this is something most people don't know much about, and not everybody. Just if you have grown in your knowledge of finance, you probably at some point realize that real estate is a good investment. So if you can buy a rental or two, or maybe you've got an Airbnb, or maybe when your kid went to college, you went ahead and bought a condo on near campus, and that's been a great investment. Maybe you've got a chalet up in Sevierville or Gatlinburg, or on the slopes somewhere where you like to go, and those are good investments, and most people realize those provide some great tax returns too. So another reason, let me look at my thing here, why we do this. Again, we do this for low risk, a lower risk, not the lowest, and it's tangible. I like it because it's tangible assets. These are things that I can go visit. I can go touch it. I can visit the people who are operating the private equity. Private equity is more of a passive business that you just invest into, and it sends you passive income. Another reason I like this is it's non-correlated. In Tony Robbins, the Holy Grail of investing, he talks about having 8 to 12 non-correlated assets, tangible assets that have nothing to do with the stock market. Whether the stocks are going up or down, it's non-correlated, okay? We also want tax efficiency here. And I like these because they actually give me cash flow. Tax efficiency and cash flow, real estate and private equity. That's what everybody's looking for. And this is where you see this elusive term called passive income. Everybody wants it, don't know how to quite get it, and honestly, it's not 100% passive, but it's something that we do because that's what we want, is passive income. As we go up here, and this is something that, for me, this was the ticket, an operating business. Okay, this is a little bit not passive. This is me being involved in an operating business. It's a great place. Sometimes you'll see people who say, should I put money in the stock market, or should I just invest in my own business? Because they know that every dollar invested in their own business, maybe it throws out $1.50. Maybe they make 50 cents on every dollar. That's a great return on their money. So I never argue with somebody who says, I'm going to continue to find more customers, serve more people, grow my business. That's a great place to invest. Now, I do see a lot of business owners, high net worth individuals who have grown their business to a point they want to diversify because it scares them to have too much going on here, and they want to take profits from their operating business and move them out. But again, this is a great thing for tax mitigation. If you own a business, it helps you pay less taxes, okay? It's a very nuanced thing. Maybe you own a heat and air company. Maybe you're a great consulting with accountants. Maybe it's nuanced. It's very unique industry knowledge. It's going to generate cash flow. Let's talk about why, So you have a unique knowledge here. Cash flow. And of course, it's going to throw off better tax for business owners. We know that from Robert Kiyosaki's cash flow quadrant, better tax treatment, and it gives you leverage. I like this because you can leverage a team. All right, now this is going to probably upset some of you because you thought you were in low risk stuff. Wall Street wants you to know it has spent a lot of money and time. The 401k, when it was invented in the early 80s or late 70s, They took money from you, put it in Wall Street for 40 years, kept it away from you, grew it because they didn't think you could handle it the right way. But honestly, they just wanted to prop up Wall Street. And they created what's called the public equities. And everybody thinks that this is safe. They think this is safe. But this is the highest risk on the pyramid right there. But this is where 70 to 80% of Americans have their money. Do you think that's a good place to have your money? Do you trust the government? You know, Nelson Nash said, do you trust an entity that creates a tax deduction or that creates all these vehicles to save you taxes or help you defer taxes? Do you trust somebody that creates that when all they had to do was lower your taxes? If they want to save you on taxes, all they got to do is lower your taxes. Why do they create these vehicles where we don't have to pay taxes? So this gets very speculative, and that's what's so funny. Speculative, I don't know if I got that. I talk to so many people who think this is speculative. They think it's higher risk. It's because of the way their mind has been trained, how they've been indoctrinated. They don't see that the safety and the safety is down here, a little bit less safe. You know, having your own business, this is a great place. But just pretending or depending on everyone else to make a return and pay a dividend from a company, or for a stock to go up and down when a tweet could influence the value of a company, you have no control. Those kind of things, to me, and I think people manipulate the stock market. People day trade the market. Look at GameStop. I mean, look how that was manipulated. It's much harder to manipulate down at these levels, okay? So, I don't know if this opened your eyes or not, if you've got questions. Maybe you have no clue what infinite banking is and you need to go figure that out and study that for the next year. Maybe it's time for you to get some of your equities off of Wall Street and onto Main Street. And these are places where you can do it. These are places where I'm currently helping people start their own business. And you could say that's speculative, but is it speculative for somebody who has been in a business for 20, 25 years and has been a high performer as an employee? Is it speculative for that guy to realize it's time to go out on his own? Is that speculation for somebody to do that? Would you invest in somebody that absolutely was a rock star in their field and wanted to start their own thing? And maybe they were willing to give you a piece of their company to help them get it off the ground? Would you buy a part of an apartment building or a self-storage facility? Or would you make a private loan or get into a group where loans are being made to fix and flippers or people who are building houses or quadplexes? Those are places where you can safely put money and start to build. But I'm telling you, most Americans, just like the food pyramid, their pyramid is upside down. They have public equities down here at the bottom, and they're trying to build off of this when they are way out of balance. Now, you can say, Kent, that's your opinion. But I encourage you to start studying. I encourage you to look at a group called Tiger 21. Tiger 21 releases quarterly their allocations, and you'll see. Now, Tiger 21 members, I think you have to have over 10 to $20 million of net worth to be in Tiger 21. But when you look, you'll see that they follow something very similar to this, okay? They follow something very similar, and public equities are one of the smallest places they put their money, whereas the average American, it's upside down. Don't trust it. Don't trust what you've been taught. Be willing to open your mind, see things differently, and when you do, I think you're going to see opportunities that come along that you've been taught are high risk, but they're really not. They just have risk that needs to be mitigated. Some of these opportunities have unbelievable asymmetric risk profiles. What does that mean? The downside has been mitigated. The upside may be exponential. It may be 10x, 15x, 20x. So putting some money in one of these things could be an exponential payout in 5, 8, 10 years. We don't get to see those things because Wall Street doesn't want us to see them. They want your money stuck there for 40 years. I hope this helped you to see this differently. If you have questions, comment below, reach out to me, and we can talk more about this.